Tom Lee over on X today reminds you, as long as the Fed is not hawkish, you should be bullish and buying the dip whenever you get the chance. So the question is, heading into an important Fed meeting this upcoming Wednesday, are stocks well priced for that? Meaning, are stocks going higher or lower following the Fed, and what is the Fed likely to say and or do? I will share that with you in this video, and let's be honest, it looks pretty good. Now, I know a lot of you guys are probably bearish, but you gotta take in different opinions, bullish and bearish, and come to your own conclusion, and there's definitely a path towards a bearish upcoming week. We do have a lot of economic data as well as earnings to contend with, not just the Fed. So first up, we need to decide if the Fed is going to be bullish, bearish, hawkish, dovish, whatever terminology you want to put on it. And I think we can, with a reasonable degree of confidence, say the Fed is probably not going to do much. The Fed report comes out at 2 p.m. Eastern Standard Time, as it always does this upcoming Wednesday. Now, the Fed, the last we heard from Powell, said the Fed has not gained greater confidence about the path of inflation. But the latest Fed speakers we have heard from, they're still talking about cutting rates in 2024. They're not talking about raising rates yet. If the Fed were to discuss the possibility of raising rates, that would be really bad for stocks. But I don't think we're really even close to that if you consider core PCE that just came out on Friday, came in at 0.3% month over month. If you annualize that, that is 3.6% on a year-over-year basis. You could run at 0.3% core PCE for 12 months and still have the federal funds rate about 2% higher than the rate of core PCE. And based on common economic practice, to get inflation down, you want to get the federal funds rate higher than the year over year or just rate of inflation. So even if things were to run at this pace for 12 months, you would still be deemed as sufficiently restrictive based on modern kind of economic theory. Now, I will point out during normal Fed meetings, that report you get at 2 p.m., as far as lately, it hasn't been that important. But the Fed's made it pretty clear. They're going to start reducing the pace of their balance sheet runoff pretty soon. And they were talking about maybe at the May 1st meeting, which is this Wednesday. And if the Fed does make any change to their balance sheet, it will be in that statement. So that's something the markets will react to. And I'll explain this as easy as I know how, okay? We all know about 10-year Treasury yields. They're marching higher. And this has put a big drag on some of your interest rate sensitive small cap stocks in 2024. You've actually went from a low of about 3.8% on the 10-year Treasury up to as high as 4.7% in 2024 alone, the first, 100 days or so of the year. That has put downside pressure on stocks. Now, the actual amount of money you get from a treasury stays the same. The price of the treasury fluctuates. So if the yield is going higher, that means people are selling treasuries, that there's a lot of supply, you could say, or maybe people don't want to buy them. Either or, it works, okay? If you see selling supply go away or slow down, that's going to mean less selling supply. Maybe that demand can start to outweigh the treasury, okay? The Department of Treasury is selling a ton of bonds right now. You also have the Fed that is rolling off bonds off of their balance sheet. Those are the two main sources of supply that are constantly hitting the markets. The Fed is selling $60 billion of mortgage-backed securities, or treasuries, $30 billion of mortgage-backed securities every month, and that has been happening for a while now, let alone the Treasury selling over $700 billion on average over the last 3-month periods. Okay. Lots of debt issuance. I don't think there's necessarily a demand problem right now. There's just an selling of treasuries. Now, if the Fed does make a big change to their balance sheet reduction, that could be super positive. Like, for an example, if the Fed were to reduce their I don't know why I keep saying mortgage, their treasury securities every month by, let's say, going from 60 billion to 20 billion, drop that by 65% or so. I think that could have a very positive effect on lowering treasury yields. And that could be very positive for interest rate sensitive small cap stocks. And I should point out, we know this reduction of the balance sheet is coming, or the slowing of the pace is coming. It could be this meeting. It could be next meeting. Who knows? But it's coming pretty soon. And that's one part of the Fed meeting coming this Wednesday. The other part of the Fed meeting is Jerome Powell bullish? Is he hawkish? What do they try to communicate to the markets? Because that's what the Fed is doing. When they get up on the podium, they do their press conference, they are trying to spit a narrative for the markets so the markets can follow that. And just the Fed saying things can restrict the economy, or restrict, monetary policy, right, via the 10-year Treasury yield, or, loosen monetary policy. And I think with what you've seen recently in the 10-year Treasury, you've become very restrictive in the economy, even more so than I think the Fed probably wants right now. Keep in mind, last week we had quarter-over-quarter GDP that came out at 1.6%. The estimate was 2.6%. So that came out much worse than expected, about 1% worse than expected. And you're going to get 2 more revisions to that, which lately have been downward revisions. So by the end of it, you're probably going to be less than 1% GDP for Q1. And the Fed has basically been begging for a reason to start cutting rates. And that's probably the reason that, they could point to. The economy is slowing down. Maybe it's not as strong as some people thought. And inflation will, throughout the rest of this year, continue to fall. That's what I'm expecting the Fed to specifically say about inflation. Now, if you think about markets and how markets will react to what the Fed says or does, you have to know what is priced in, right? That's common sense. You have to know what's priced in. If we actually take a look at what's priced in, and this is why I'm bullish for this week, or specifically at least for the Fed, there is only one cut priced into markets this year, and that cut is priced in for September 18th, 2024. Barely. I mean, just barely. 43.8% chance of a cut September 18th, 42.6% chance of a pause. If it's not in September, it's likely going to be November 7th, where you have 43.6% odds of a cut and 33% odds of a continued pause. And if it's not November, then it'll change to December. And that really depends on the data coming out, in which we will have some data coming out this week, and I'll talk about that briefly here in this video as well. But you're only pricing in one cut for 2024. The Fed is pricing in more cuts than that. The Fed is pricing in a solid 2 to 3 cuts in 2024. Most Fed officials are at least going to say around 2. And that's just because the federal funds rate is so much higher than the rate of inflation. There's a lot of real restriction on the economy, again, based on modern, monetary or economic theory, okay, where you want to get the Fed funds rate higher than the rate of inflation. You're far higher than the rate of inflation right now. And it's more important, as Tom Lee would say, the Fed is trying to manage the business cycle. Okay, so why is that good? If markets are only pricing in one cut, and a lot of people would say they're not expecting any cuts if you were to ask fund managers, then that means even if the Fed is more hawkish than they were last meeting, you're probably already pricing that in. 10-year Treasury yield sitting at almost 4.7%. You're already pricing in a very hawkish Fed for this week. If the Fed is even remotely on the dovish side, that could be super good, like super good news. If the Fed is dovish, then it's probably priced in, or hawkish, then the Fed is, the markets have probably already priced it in. Okay, so it's all about pricing. Now, I would be bearish as hell if you were pricing in 3 rate cuts still. Bearish as hell. But you're not. You're pricing in 1. And I think that sets you up for an upside surprise from the Fed. Keep in mind, recently in 2024, Jerome Powell has been just overly bullish. I feel like he should have been more bearish when some of those other inflation reports came out. He was not. So if Powell were to come out and just be super hawkish, I think that would take a hit to his credibility. Like, they can't stick with a narrative. I think that would be kind of problematic. So for these reasons, I am bullish for Wednesday's Fed meeting. Now, if you are an investor in the markets, which I assume you are if you're watching this video, you do have a bunch of earnings coming out as well. I will point out Amazon is one of your big tech names reporting Tuesday and after hours. And there's a ton of other companies. Feel free to, pause this video and take a look for yourselves. But Amazon, I'm expecting good numbers out of Amazon. I'm expecting Amazon can do well. Okay, so I'm not worried about Amazon all too much. AMD and Supermicro, that could be problematic. If Supermicro did not pre-announce, like they did not about 2 weeks ago, if that is foreshadowing a miss on earnings, that would be bad because Supermicro, AMD, Nvidia, none of those stocks are priced to miss on earnings or priced for growth to really slow down in any kind of meaningful way. And Supermicro does a lot of their business with Nvidia, so if Supermicro misses, odds are Nvidia is going to miss about 2.5, 3 weeks from now. And that could be a problem for the markets. Now, I will say, I think there's a little bit more fear baked into these stocks now. Nvidia, for an example, is down about $100 from its all-time high. So you're not priced in a super fearful way, but you're definitely not priced for a blowout quarter. So if things are just good as Supermicro and AMD, I think that's good enough. And if they're not, that's problematic because basically one of the biggest investment themes in 2024, if not the biggest, still is AI, right? And if you have to sit there and say, hey, maybe AI is too overhyped, that could be problematic for markets. And I think if Tuesday is negative, then it sets you up for maybe an even better reaction from Fed Jerome Powell coming on Wednesday. Or maybe things are just all bad. Maybe Supermicro's bad, AMD's bad, Amazon's bad. It's all bad this week. I don't think so, though. I think this is the more logical approach based on what we're currently dealt with. Now, Apple will report earnings on Thursday. I don't think Apple's all too important for the markets at this point. I think everyone's expecting bad numbers from Apple, and I think that's pretty well priced in to Apple stock. And Apple hasn't really done much of anything in 2024. It's actually fallen around 10% last I checked. So you don't really need Apple to participate for the markets to do well, but I think you definitely need some of that AI theme. So believe it or not, the biggest wild card for markets this week is probably AMD and Supermicro earnings. That's it. They will probably have the biggest say on what happens to markets, at least on Tuesday, probably even on Wednesday. Again, I do expect the Fed will have a positive reaction on the markets, but there's a chance the Fed starts to talk about raising rates again, or maybe we're not at neutral, or maybe we're not restrictive enough, and that could obviously be problematic as well, but that's not my base case, and I still think that's a pretty low overall probability. Now, if you take a look at the economic data coming out this week, start off with Monday here, and you don't really have much for Monday. For Tuesday, you really don't have much either. You do have GDP data and inflation data coming out for the Eurozone area, but that's pretty much it. Wednesday, you are going to get ISM manufacturing PMI and JOLTS job openings. Keep that in mind. JOLTS job openings falling, if that's what happens, would show the economy's maybe not as strong. Labor market's not as strong as we thought. Job openings going higher would show, labor market economy likely stronger than we would, or the Fed would like. Okay. I think any investor out there should hope for the strongest economy possible because that's ultimately the biggest thing that drives stocks. but the Fed probably wouldn't want to necessarily see that. Now, you have the Fed on Wednesday, like I said. Thursday, you don't have much. On Friday, you're going to have your biggest data of the week, non-farm payrolls, as well as the unemployment rate. So here's the deal here. If non-farms were to come in under 100,000, that would definitely give the Fed a reason to start cutting rates. So that could be good. But that would really start to open the door to recession fears. And if you start to get fears of a recession coming into the markets could get much worse from here. Just imagine a scenario where markets are currently trading at about 21 times forward earnings, and earnings estimates are around $250 of EPS for the S&P this year. If the expectation starts to become that maybe we do go into a recession and maybe next year's earnings will come in around 230, and maybe you see a multiple that comes down from 21 down to 19, which could be very reasonable if we start to expect a recession. I mean, 19 is pretty expensive historically as well, right? 21 is very expensive. Well, that puts you on the S&P back to about 437. And if we take a look at where the S&P is right now, or the SPY, it's trading at 508. Okay, so to get down to 437 from here, that would feel like a big fall. In the grand scope of things, you were just there October, November, December of 2023. But to get that would be about a decline of 14%. And if you were to see something like that, I mean, momentum strong to the downside. It wouldn't surprise me if you overshot that to the downside. That would be like 15% down from here. That would be putting the markets into a crash. That would be from the all-time high down to 437. That would be a reduction, well, of about 17%. So not technically in like a 20% crash, but that could be pretty close. And that's saying if earnings expectations were just 230. They could go lower than that. So it would be problematic to see a bad non-farm payroll report nonetheless. You're expecting 190,000. Great. Anything above 100,000, probably seen as good news. The economy's doing well. Anything less than 100,000, not so good. Unemployment rate, unfortunately, I don't think that matters too much because it's moved up and down, right? The unemployment rate has been pretty volatile, believe that or not, going from as low as 3.5% in July of 2023 up to 3.9% as far as February of 2024, back down to about 3.8%, plus or minus, 2 points. It's not going to be a huge deal. Now, if you do hit 4% for the unemployment rate, if that were to happen, maybe that would spark a little bit more fear. But I mean, odds are you probably just go back to like 3.9 or back to 3.7%. So I don't think that's going to be a big deal either. So overall, when I net all of this out, I come to a pretty optimistic scenario for next week. And keep in mind, on the NASDAQ, you have fallen about 8.5% from your all-time high down to the low that you've seen on April 19th. The dog just fell off the bed. You did fall about 8.5%. So that definitely shook some bulls out of their position and gave you a little bit of a reset. Now, on a technical basis, you did find some resistance around that 20-day moving average. I think Tuesday, you're either going to get the break above that with SMCI, AMD, and Amazon earnings, or you're going to see a fall back to that 100-day moving average around 423. Now, that would be about $8 lower from where you are in current prices. If the Fed were to be bad, if the economic data is bad, if the earnings are bad this week, then you fall to that 200-day moving average. But I don't think it's likely. I don't. I think you're much better priced for the Fed. I think the fact that you had that AI sell-off 2 weeks ago, you're a little bit better priced for not spectacular earnings with AI stocks. And with the overall 8.5% decline in the NASDAQ, I think you are set up for a pretty good scenario, as long as the economic data does not come out bad and signal some kind of recession. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day and your weekends. I will see you in the next one.